All right, so I hope everyone is doing fine. Last time we looked at some questions from investment appraisal. Today we are going to look at another section from working capital management, where basically they question you about inventory, receivables, payables, basically working capital. And this is one of those other questions that you expect to find in section C. So we do a couple of them, but as I said, a couple of more have been done on the platform, so you can always go there and see how those have been done. So today we are going to start with this question called WQZ. So as we said, start from the requirements. The requirements are calculate the cost of the current ordering policy and the change in the cost of inventory management that will arise if economic order quantity is used to determine the optimum order size for products KN5. Then describe benefits of just in time. And then, of course, calculate and comment on whether the proposed changes in receivables management will be acceptable, assuming that only 25% of the customers take the early settlement discount. What's the maximum early settlement discount that could be offered? So those are the questions that we have. And now we need to determine also the factors that should be considered in formulating a working capital policy on management of trade receivables. So those are our questions. So we can now go to the scenario. Section C scenarios for our level are not always very detailed. So usually the idea is that you are going to you're going to get 20 marks out of the question. So, and 1.8 minutes per mark. So when you multiply through there, you see that you're going to be at around 36 minutes. So the idea there is to not spend so much time on each question. 36 minutes per question, section C. In fact, for some of them like this one, you could even spend less time and then balance it out on one, which is a little bit challenging. So when you look at what they told us about WQZ, they want to make the following changes in the areas of working capital management. So they have given us for inventory, they want to change the order size for product KN5, and they want to determine using the EOQ. So when you know EOQ, you already know what to do with this. And then you just look out for the different variables that you need. So the demand, 160,000 in the coming year. We have been ordering 10% of annual demand per year. Then the ordering cost is expected to be 400 per order, but the holding cost is 5.12 per unit per year. We do have a buffer inventory of 5,000 units, whether orders are made by the traditional method or using the economic order quantity model. So we shall try to explain some of these items as we go. Let's first look at the receivables. For the receivables, they want to introduce an early settlement discount of 1% for customers who pay within 30 days. And at the same time, through improved operational procedures, they want to maintain maximum average payment period of 60 days for those who don't take the discount. So 25% of the credit customers will take the discount if it was offered. Then we have some costs that we are going to save in admin and operational costs of 753,000 per year after improving the procedures and introducing the settlement discount. So the credit sales are 87.6 million per year. Receivables are currently at 18 million, and they're not expecting to change the credit sales. The company has a cost of short-term finance of 5.5 per year. So you have your scenario cut out for you, and therefore what is left is to start calculating the cost of the current ordering policy and the change in the cost of inventory management that will arise. So we do have a formula sheet. This one is, let's open another one. All right, so we do have a formula sheet, and the very first formula on there is the economic order quantity, and it's what they're telling us to use. So, like I told you, these formulas are given to you, but they don't tell you what each term means and how to use it. So that is what you need to learn on your end. So EOQ is economic order quantity, and is given as the square root of 2 multiplied by the cost of ordering times the demand divided by the cost of holding. So now they told us for the inventory, they want to use EOQ. So demand is 160,000. Then they have been ordering 10% of annual demand per order. So traditionally, and EOQ. So traditionally, we can actually first work out traditionally here. And traditionally, they have been ordering. So demand is still the same, 160,000. Then the order quantity has been 10%. So which is 16,000. So how many orders would that be? Divide these two. So that gives you 10 orders per year. That's what has been happening traditionally. Now, ordering cost 400. 400. And then holding cost 5.12. Okay. Then we have buffer inventory. Now, buffer inventory means, if you are ordering, when you run out completely, chances are there will be some time before the order arrives. And therefore, what happens when people want you to give them something, but you tell them that first wait for me, I've ordered, but things are going to take some time to come. So what you do instead of ordering when you run out is that you create what we call buffer inventory, such that you always order once you reach that level. Whether when you have, now in this case, they have told us it's 5,000. It means that once I reach 5,000, I order. Or you always have 5,000 units that are there in case you run out, such that you use them as your order is coming. So now this is ordering cost per order, holding cost per unit per year. So now we can have the real costs, ordering costs. So if you're ordering for 400, so just multiply that by the orders. That gives you 4,000. So if you're ordering and you are incurring 4,000, then what about holding costs? Now, remember that for holding costs, we have 5.12 per unit per year. But if you're going to do, how many units are you going to have? So now you need to actually determine it like this. Because you order, you start, you have the units held. The first thing is the 5,000 units. Okay, I'm just going to show it here broken down, but normally we do it at once. So it has the buffer, which is the 5,000 units. Because those ones, they are saying they have to always be there. So that's buffer stock. So that is going to be always available. But then you also add the average inventory. And average inventory basically is that you ordering 16,000. So you order 16,000, then they run out, then you order again. So at some point you have 6,000, at some point you have 0. So basically it's the average of 16,000 plus 0 divided by 2, or rather 16,000 divided by 2. That's the average inventory. So, which means that at any one point, on average, you have about 13,000 units. Okay, that is the 5,000 units plus the average inventory. So the holding cost is going to be 13,000 units multiplied by the holding cost per unit per year. It gives us 560. Then you can now get the total cost, 70,560. Now this is the traditional method. Now if you are looking at EOQ, we are going to do EOQ. The demand is still 16,000. Okay, so if you are doing EOQ, we are basically going to use the formula. Okay, so let me not repeat myself here on the variables. Oh, okay. Don't want to repeat myself on the quantities here. Basically, we are going to use this formula, which is the square root. This formula is there in the Excel sheet that you use in the exam, SQRT. But if you don't know it, you just multiply everything and then you put brackets and say power half. So 2 multiplied by the cost of ordering, which is 400, multiplied by the annual demand, which is the 160,000, divided by the cost of holding, which is 5.12. That will give you the economic order quantity, which is 5,000. So after that, then you have the holding cost. Or actually, let's first start, how many orders are going to be? Because if the EOQ is 5,000, that means that you are going to have how many orders divided by 5,000. So those are 32 orders. So we can have the ordering cost. Which is going to be basically the cost of ordering, which is 400 times 32, which gives us 12,800. That was the holding cost. And I said we can do this in one go. Basically, it's going to be 5,000 over 2 plus the buffer inventory. Okay, now that is the cost of, that's the average inventory. Then you multiply this by the cost of holding. Now, if you think that this is something difficult for you to do, you can still break it down like I did and get the answer. The examiner,
Pardon, the holding costs?
the holding cost. So we first got the units that are held, which I showed you before by saying we have the buffer inventory, which is the 5,000, plus the average inventory, which is basically the orders, that the number of units that you order every time divided by 2. The average inventory. So then everything you multiply it by the cost of ordering per unit. So here I put it in one cell, and here I broke it down. Okay?
Okay.
Yeah.
Yes.
Then from here you can get now the total. Total cost is 51,200. Therefore, you can calculate the savings as 7560 minus 51,200. This is how much you save when you use EOQ. Now, every time you do this question, you have to go back and see if you've answered the part very well. They said, calculate the cost of the current ordering, which you have done, and the change in cost of inventory management that will arise if we use EOQ. So they want you to give them two things: the current cost, which is this one, and the change, or the savings, which is this one. So if you do this and you do EOQ and you don't give them the savings, you won't get the mark for the savings. You understand? So that is something that you should keep in mind. Now, second question is asking you to calculate the benefits of just-in-time procurement policy. Now, let's first understand what is just-in-time. Now, just-in-time means, as opposed to having a big warehouse where you keep all the inventory that you're going to sell, and also the inventory that you have bought that you are going to start working on, you'd prefer to have a situation whereby you just have the inventory just enough. People come and order, and then when they come and order, you basically don't take so much time before you are able to give them their order. So you basically work their order just in time. And I normally give an example of a Rolex stand whereby you don't find when the man has made the Rolex and it's just waiting for you to buy, because that will be now inventory. But rather, you come and tell him what you want and he prepares it first. Now, for it to work, of course, things have to happen fast. Like, you should be able to scale up based on the demand. You must have suppliers who are trustworthy, because that means that when you need to have the inventory, when customers have come, then they shouldn't tell you things like, sorry, we shall deliver tomorrow, we can't deliver today. Then also, you must be able to the steps taken to make the product should not be so difficult and decide that you're going to have problems with the delivering your orders on time. Now, but here they have asked us a question to do with the benefits of just-in-time. So the first benefit you can say is that inventory holding costs will be reduced. Because, as I've just explained, you don't have to hold so much inventory. You only hold just enough to satisfy orders when clients come for the day or for the month, depends on how you look at it. And therefore, you don't have to have a warehouse where you have your inventory sitting there and therefore incurring costs on it. Then another thing is that you will have reduced capital requirements. And let's say reduced working capital requirements. Now, working capital basically means how much money is stuck in inventory and receivables. Okay, so if you have less receivables, then you have less working capital requirement, and also inventory. But in this case, we are looking at inventory. If you have less inventory, then you have less working capital requirements. But if you have so much inventory, you have to have a lot of money tied in that warehouse. So that is the thing. But also, it can improve on service delivery and productivity because you are catering to the needs of the client when they come by not, let's say it's not really custom, but because you don't hold so much inventory, you have less costs. So you focus on the quality of the goods that you provide to these people, as opposed to throwing everything in the warehouse and waiting for people to come and buy. So those are some of the advantages of just in time. But you need to also understand its problems. Okay, and I'll implore you to go and find out those in your textbooks so that you be clear on what those are. Then the other thing is to calculate on and comment on whether the proposed changes in receivables management will be acceptable. Assuming only 25% of customers take in the early settlement discount, what's the maximum early settlement discount that could be offered? These are two questions, so don't confuse them. Let's first handle the first one. The first one is stemming from here, whereby we want to introduce a settlement discount of 1% if you pay within 30 days. And also, the rest we want them to pay within 60 days. We expect 25% customers will take the discount if we offer it. And we shall have some cost savings. Here we have our current sales and the receivables. So to calculate this, you need to first of all understand the current situation. So what is our receivables and sales? Therefore, what are the receivables days? So receivables, they have told us it's 18 million. Sales, they have told us 87.6. And now, for the days, usually it's going to be the receivables divided by the correct sales times 365. You normally have to check and see whether they told you to use a different time zone, like not time zone, but they can tell you to assume the year it has 360 days. Here they didn't say that, so we are using 365. So right now, people are taking on average 75 days. Okay, I don't have to put days there because it already has been put. Now the new arrangement, receivables will be, they are thinking that 25% of the receivable of the customers will pay within 30 days, and then 60 are for the others. So, which means that the receivables days are actually going to be 25%, they will pay within 30 days. And the rest, which is 75%, they pay within 60 days. So in essence, they want the receivables to reduce to around 53 days on average. Now, what are the receivables for this? Remember here we did this divided by that times 365. So here we are going to say this divided by 365 times the revenue. So which is about 12.6. So there will be a reduction in receivables. So reduction in receivables, which will be basically 18.7 minus 12.6. So this is a benefit of 5.4. However, for us getting this benefit, we are going to give away a discount. So we are going to have to lose some money. Okay? So, but when we reduce receivables, what really reduces is actually we have what we call interest savings on receivables. Because you see, when you have receivables, because that's working capital, you normally finance it using a loan. So it means that we shall save interest of how much? They told us that interest is at 5.5. So we shall save interest of 297,000. We also have admin and operational savings. They told us this was 753. Okay. So we have that. And now, what about the cost? So the cost of the discount. Because if we didn't give the discount, we would get all the money, but now we are losing 1%. So we are losing 1% of the money that we should have got in our sales, but not all of it, because we are only giving this one to 25%. Okay? And I want to make this one negative because it's a cost. So that is the cost. So when we calculate, we see that there is a net saving or a net benefit. So because there is a net benefit, they said we calculate and comment. Okay? So the comment is, since there is a net benefit, we should the proposed change is acceptable. Let's say the proposed change is acceptable. Okay. Now, that is the first part of the question. But they said also, if only 25% are willing to take the discount, what's the maximum ultimate discount that we could offer? Now, to do that, we would like to find out how much discount would cause us to lose all this benefit. Okay? So, remember that the cost of discount. So basically what we are going to do is we are going to say the benefits, the benefits, we already know them, they are these two. So I can actually sum them up. Those are the benefits, but the cost depends on the calculation that we did here, which was basically 1%, but now we want to know what discount is going to be. So this is the benefit. Now, for me to have 0, that means that the cost should also be 0. or I mean should also be the same, 105. Now this is where you bring in your math. X% of the revenue, okay, which is 87.6 multiplied by 25% should equal to 1,050,000. Therefore, X will be equal to, okay, basically you get 1,050,000 divided by the revenue, okay, divided by 25%. And I think since this one is brackets here, so we are going to say multiply. Okay, so which gives us about what? 4.8%? Yes. That's the maximum we can give. If we exceed 4.8%, we'll make a 0. And I can test it here. If I come here and I put here 4.8%, you see that I am in a negative. Okay? Ideally, it should be 0, but this is not just 4.8. It is 4.79, blah, blah, blah. So it's going to not give me a very perfect answer. But if I wanted to have it as a perfect answer, I'll just reference it here. And you see that gives me a 0. So that means that I can't go beyond 4.79% if I'm giving settlement discounts. Is that clear?
Yes, it is.
Okay. So then we have one last part for this. He's saying discuss the factors that should be considered in formulating working capital policy on management of trade receivables. Now, trade receivables working capital policy. Now, basically, it depends on really how much receivables do you have. Okay? So, first of all, the level of investment in trade receivables. Now, there are some companies that most of their sales are on credit. So they will have very huge receivables. Then there are others where most of their sales are cash. So like a supermarket. Supermarket doesn't usually sell on credit. So if they do, perhaps if they do, they will have very few receivables. Okay? Now, if you have very few receivables, that means that you may not have to really suffer so much trying to control that receivable amount because it's small. But if you have a huge receivable on your balance sheet, then it is very, very important that you manage that because that means you have so much money tied up and therefore you would rather that money flows and then you actually are able to get that money back. But also the cost of what? Of working capital. So let's say financing. And here we are dealing with if you want to go and get some short-term finance, how much does it cost you? Okay, you want to get short-term financing, how much is it costing you? Because if it costs you so much, then you don't want to have so many receivables because you don't want to have so many receivables if the cost is not really, like if you need to finance them expensively. But if the cost is not so high, therefore you can afford to have many receivables, then that's what you do. You have many receivables. So that's basically how it works. Then you can also, there's one thing that you need to know is that competition matters. Competition offer on receivables. So basically here we're looking at the terms offered. Now, one thing you should know is that if your competitors are giving 30 months payment terms, you can't give them 20 because then they will go to your competition. So in a way, what they give is going to restrain what you can be able to give them. So you'd find yourself having to give them basically, you give them basically more, okay? Or at least the same. So if they are giving 30, you can give them 30 or 35, but you can't give them less because they'll go to competition. So that will actually also dictate. Also the risk tolerance. Receivables have bad debts attached to them, whereby some people don't pay back your money. So you have to question yourself and see whether or not you can sit with the fact of not receiving all your money, or whether you feel like you should not have to deal with that, and therefore you should do take it, give it somebody else to put. So you can have things like factoring your debt, okay? You can trade your receivables if you are not going to take that risk. Then the other thing is that liquidity preference. Liquidity preference means some companies prefer to have cash than sales. Or basically, when you sell on credit, then you have so much sales, but you don't have the cash. And some companies can't survive being illiquid. So if your issue is liquidity, then you may try to have terms whereby people pay you earlier on. As well, you can sell your receivables so that you can get that that money coming in, and so on and so forth. These are just some of them. But remember, this is 5 marks, so you don't want to give 10 points or whatever like that. You can give about maybe like 1 point, 1 mark per point, and you have yourself 5 points. So that is something that you can consider. Now, when you got the solution, you see how this has been done, but most importantly, you'll be able to find examiners' comments on this question that should help you prepare better in case something like this were to show up in the exam. Okay, I don't know if you have any questions on that before we move to the next question.
I don't.
Working capital policy. You're asking whether working capital policy is an answer. But this question was about working capital policy.
Oh, okay.
So, yeah.
Okay.
Okay. Then let's do another question called fleet. And this question is asking us to calculate the cash balance. By the way, as I mentioned, when it comes to working capital, you need to know receivables, payables, inventory, and cash. Okay, those 4. And The videos that I made for these are very clear with good explanations and questions that are attempted on this. But we are going to use today and tomorrow to try to do as many questions from these as we can get. So this one that we are doing already, I'm seeing it has some cash in it. So, okay. And then it also has discounts and receivables. So this is a question that is good. And when you see what they're asking us to do here, they're asking us to calculate the cash balance at the end of each month in the 3 months period, then the forecast current ratio at the end of the 3-month period, then assuming we expect to have a short-term cash surplus during the 3-month period, discuss whether this should be invested in shares instead on a large stock market. So this is 10 marks right here. Then there is another part which is for 10 marks for calculating or evaluating whether Flit should offer the early settlement discount, and then 2 ways in which companies could reduce risk with foreign accounts receivable. So let us see what the scenario says, then we can handle this. So for Flit Co, they are saying they want to prepare a cash flow forecast for the 3-month period from January to the end of March for one of the divisions. And this is what they have as sales volume. Then the selling price per unit is 800. Selling price increase of 5% will occur in February, and sales are on 1 month's credit. Production of goods sold for sale takes place 1 month before sales. Each unit produced requires 2 units of raw materials costing 200 per unit. No raw materials inventory is held. Raw materials purchases are on 1 month's credit. Variable overheads and wages equal to 100 per unit are incurred during the production and paid in the month of production. Pending cash balance in January, 1st January is 40,000. A long-term loan of 300,000 will be received at the beginning of March. And a machine costing this much will be purchased for cash in March. So we can actually first answer this part, but let's read this part so that we can now go and see exactly what they want. I advise for this kind of question, there is no connection whatsoever between part A and B. So you can right away after reading part A, start doing it. So, but for part B, they are saying that we are currently, we have total income of 30 million per year, 80% is from credit sales, and there's a net profit margin of 10%. Because of competition, we have lost market share, and we want to win back former customers. So the director of sales has pointed out that we can, the competitor is offering early settlement of 0.5% if you settle within 30 days. But for us, we don't offer such. So suggest that if we could match this settlement discount, the income from credit sales would increase by 20%. Then the credit customers have an average of 51 days to settle the invoice. 0.5% of the company credit sales have historically become bad debts each year and written off as irrecoverable. The Director of Finance has been advised that the offering any settlement discount of 0.5 for payment within 30 days would increase administration costs by 35,000 per year, while 75% of credit customers would likely take the discount. The credit controller believes that the bad debts would fall 0.375% of credit sales if the early settlement discount were introduced. Cost of finance 4%. And here they have told you to assume 360 days. Okay, I've just mentioned it in the previous question that in case they ask you to assume 360 days, that's what you use. If they don't tell you, use 365. The reason why they tell you to assume 360 days might be to kind of help you with the rounding. And I've been asked by people that what happens if I use 365 days? And the answer is probably you lose a mark or two. Okay, because you have not followed the instructions. Okay, so let us first deal with this cash balance at the end of each month in the 3-month period starting from January. So now when you are doing this, we need 3 months of January. So January, February, March. So now, although we need January, February, March, we have prices now. For example, the sales are on 1 month credit, which means that the sales of December will be paid in January. Okay. Production of goods for sale takes place 1 month before sales. It means that the goods that are sold in January will have been produced in December. And this is how much will have been incurred. 200 per unit. And we shall have bought it on 1 month credit. So we shall pay that in January. Variable overheads paid in the month of production, which is the previous month. So you have to be careful with the figures as they are given to you. And so because of that, I am going to demonstrate all the months, and then we only keep the part for the 3 months so that you understand. So now what is going to first happen? So we have a cash balance. Okay, they want us to do for 3 months, so we can put here January, February, March. Now, so if we start with the selling price per unit, 800. So the sales of December shall be paid in January. So we can put here receivables because they are not sales in that month. So in January, we shall get sales of December, which is 1,200 multiplied by 800. So that is 960,000. Then now the January sales will be in February, 1,250. Then the February sales will be in March. Now the March sales will be in April, so we don't have to put April for that matter. So they're asking us for 3 months. So those are the receivables. What else is income? So production of goods sales, these are costs. We have an opening balance in January. That's not a revenue. We shall deal with it down. Because I forgot to mention, when you are looking at a cash budget, you start with incomes, you list them, then you list expenses, then you have a net income or expense, then you have cash brought forward, then cash carried forward. So we are now starting with the incomes. So the incomes, we have receivables, another income here there is a long-term loan of 300,000 received at the beginning of March. So we have a loan, 300,000. So those are the incomes. So we can actually add these ones up. These are the incomes. Then now we go to expenses. So production raw materials, 200 per unit, and their materials purchased on 1 month credit. So the raw materials that we shall need for now, you need to understand that production takes place 1 month before sales. So that means that the production for January takes place in December. So in December, because they said that which one needs raw materials costing 200? So what are the raw materials that are going to be needed for January? Because it needs 2 units, okay? So if we have 1,250 units, then it needs 2. That means that is 2,500. Okay? So 2,500 units. But those units, since they are in January, they will actually be, as we said, they will be made in December, 2,500 units. So each one costs $200, and those are purchased on 1 month credit. So when you buy them in December, you pay them in January now. So what this is going to do is that it's going to make it such that the production is 1 month before, but the payment is in that same month. So which means that the best, you just do 1,250 raw materials. You just do 1,250 multiplied by 2 multiplied by 200. That is the raw material in January. Then in February, 1,300 multiplied by 2 multiplied by 200. And in March, 1,400 multiplied by 2 multiplied by 200. Okay? So that is for raw materials. Then variable overheads are 110 per unit, and they are incurred during production and paid in the month of production. So now these ones are paid in the same month of production, which means that the ones of January would have been paid in December. So the ones of February will be paid in January. So you need to be very careful with the way they are listing these ones. So February is 1,300 multiplied by 100. That is the one in January. Then the one of February will be coming from March, 1,400 multiplied by 100. And then the one of March will come from April, 1,500 Okay, so those are the variable costs. What else? This is not yet coming. We are still now looking at the costs. There's a machine of 400,000 purchased for cash in March. So we do have a machine purchased for cash in March, 400,000. Okay, so we have all of the expenditures. We have our expenditures. So from there, you can calculate now the net. Okay, so this is the net cash flow, or you can say net income or expense. So which is 330,000. This one we can maybe give it this. Now, so we can have opening balance or the cash brought forward. So the opening balance they told us was going to be 40,000 in January. Now, to get the closing balance. So if you had 40,000 and you have another 30, so basically it's the sum of this and this. So that gives you 370 as the closing balance. But it also becomes the opening balance of the previous month, of the next month. And then you can now transfer these ones. Okay. So by the end of let's just confirm for March. For March, we'll be getting the 1,300. Yeah. Okay. So the closing balance becomes 940,000 for March. So now you realize that this is not so much of a problem. The problem is to basically follow the instructions on when the payments are made. Now, this is what they call cash accounting in financial reporting, whereby as opposed to recording receivables and payables and sales and all that, you only record when money gets paid. So we have done that, but then they want us to calculate the forecast current ratio at the end of the 3-month period. Now, how do you calculate current ratio? So current ratio is equal to current assets over current liabilities. So we need to know what are the current assets, what are the current liabilities. Now this has some connotation to it, because by the end of March, what are the receivables? What's the inventory? And what's the payables? Because this is at the end of month. So receivables, remember that the sales that you have made in March will be payable later. So that means the receivables will be 1,400 multiplied by 800. Okay, that it will be. But they're saying the selling price increase of 5% will occur in February. Oh, and we need to check whether we handled that in the previous one. I think in March, we needed to multiply by 1.05 because there was an increase of 5% in February. So now we are going to also take that same increment. That is going to be the receivables as of March. Now the inventory as of March will be, so remember inventory in March that we are producing will be what will be sold in April. So now what we are going to do is that we are going to get this 1,500 and then we multiply it by 200 for the 2 units, and also we add the variable cost. So, which means that for inventory we shall have 1,500 multiplied by 200 plus 100, and these are 2, so 200 times 2 plus 100. That is going to be the inventory. And now the payables, because remember for the payables, we have, remember that the raw materials of April are made in, we're producing in March, but we are paying in April. So that means that we have that amount pending. So this can't just be the raw materials of April. So 1,500 multiplied by 200 multiplied by 2, which is 600,000. So then I can now get the current ratio. It's going to be receivables plus inventory divided by payables. It becomes 3 point. Oh, I forgot something. Cash. So cash is one of the current assets. So what will be the cash balance? 992,000 as of the end of March. So you add that cash as well. So it becomes 4.86 as the current ratio. Is that clear?
Yes.
Okay. Now the other question is that assuming that we want to have a short-term cash surplus, how should we invest? Should we put it in the shares of listed company or not? Now, when you have surplus, you normally have either short-term or long-term. Now, you always invest the same way. For short-term, basically you can invest in bills, okay, treasury bills, basically short-term things. So you can You can invest in a bank. Okay, they can deposit the money, save the money. You can maybe pay off suppliers early. Okay, like early settlement. So that is short term. But for long term, here you can invest in the stock market, for example. Long term things, you can invest in bonds. You can expand. Okay, that could be like maybe buy warehouse. So this is when you have money and it's a surplus and it's a long-term surplus. And in this case, when they told us that we have a short-term cash surplus, we don't want them to invest in shares. Okay? Because, okay, when you invest in shares, normally there is a high risk that you might lose your money in the short term, at least. Because what happens with the shares is that you buy your shares and the company grows and grows, and maybe the CEO is caught on the kiss cam and therefore has to resign and the share price falls. Now imagine that happens to you and you have short-term surplus. It means that if you want to pull out of that stock market, you make a loss. So it is advisable that for such things, it's better to basically invest in short term where you can get your money and get it back running because you have a short term surplus. But if it's long term, and basically what we mean by short term surplus is that this month I have a surplus, but it's maybe because there is a one-off thing that happened that I don't expect to have that surplus next month. So that's short term. But if you can start realizing that, okay, consistently every month I'm going to have a surplus of this much for the following maybe 1 year, then that is a sort of a long-term surplus. So you can have that invested in a long-term thing. So basically that's what we are saying here, short-term, long-term. Okay, then let's go to the second question, where they want us to evaluate whether we should offer the settlement discount. So now this discount, we are going to deal with it like we saw. So right now, total sales 30 million, 80% credit sales. So you can start by saying, what's the current situation? So the current situation is we have credit sales of 80% times 30 million, which is 24 million. Those are the credit sales. Now, net profit margin 10%. Then sales director has pointed out that the major competitor is offering 4.5 if you pay within 30 days. Right now, people take 51 days. Okay, people take 51 days. So, current. So let's say, because these are the sales, so we can call these ones receivables actually. Credit sales become receivables. So receivables days, on average 51 days. Okay. Okay, and so what we need to do is to say, okay, when we give the discount, settlement discount, whether we shall benefit, because they are trying to give 0.5 settlement discount. So, but now, here as it stands, when we make the discount, we are going to have some, they are saying that when we give the discount, let's see. Yes, increase admission costs. I saw something about increasing credit sales. Yes, they say that if we match this, the income from the credit sales would increase by 20%. Okay, so right now the income is 24 million. So we shall increase. So increase in income after discount will increase. So we increase by 20%. Okay, so which will become 28. This 28 is the increased income, not increase in income. That's the new income. So if you want to know the discount, the increase, you just subtract these two. So credit sales will increase by about, the increase will be about 4.8. But remember, the net profit is 10%, net profit margin. So increase in profit will just be 10% of this. So there's that benefit that will come for 80,000. But also, the bad debts will reduce. So the current bad debts is about historically, the bad debts have been 0.5%. So 0.5% of the receivables, which is 24 million. That's 120. Then the new bad debts after the discount is going to be 0.375%. Multiplied by the new receivables, which is 28. So 108. Okay, so the bad debts have reduced, so reduction in bad debts okay. Now there are two things we have seen. profit will increase by 480. Bad debts will reduce by 12,000. And now, also, since the receivables have increased, so there will be an increase. Okay? Because you see, right now the receivables is 24 million. Okay? That's the receivables. But not all of them will take the discount because the discount is given 0.5. Okay? So the receivables we said this is the new this is the increased income after discount, 28.8. But some of them will not take the discount. So the discount will be taken by about 75%, and then 25% will not take. So we shall have receivables days. Remember that when you take the discount, you pay within 30 days. So 75% will pay within 30 days. Whereas the rest, which is 25%, will pay within 51 days. Okay, on the one that they are currently taking, which means that about 35 days, this is going to be the new receivables days. Therefore, new receivables will be 35 out of 360 multiplied by the 28.8. So, which means that the receivables will be actually 2.82. Now, what are the current receivables? It's going to be basically 51 out of the 360 multiplied by the 28.8. Not the 28, the 24, because currently we don't have. So actually, let me change this one to create sales. Increase the income after discount. Because these are create sales, the receivables themselves are basically 3.4. Because on average, they take 51 days. So these are the receivables. These are the current receivables. So there is a reduction in receivables of 580. And we said that when you reduce receivables, we have savings, interest savings from reduced receivables. And remember that is going to be 580 multiplied by the interest, which is 4% per year. So that is the interest saving from reduced receivables. And then one more thing is that since you are giving a discount, you also have sort of the cost of discount. So you would have got the whole amount of money, 28.8, this one, but you are going to give them a discount of 0.5%, and 75% of it will be taken up. So basically, this one multiplied by 0.5% multiplied by 75%. That is the cost, 108. Now, everything that I've highlighted, you need to categorize them, because right now I've just explained each of them, but you have the benefits, and the benefits, we have increased net profit. Okay, this is a benefit. You have reduction in bad debts. It's a benefit. You have interest saving on reduced receivables. So these are the benefits. Benefits are 515. Then the cost, we just really have one, cost of the discount. So, having got that, so there's a net benefit of 407. Okay? Oh, there's another thing that I've forgotten. There will be an increase in admin cost of 35,000 per year. So we have increased admin costs. Oh, increased admin costs. 35,000. Then you can have the net benefit of 372, 200. Okay, so because there's a net benefit, we should offer the early settlement discount. Okay, so that is how that is done. Don't know if you have any questions on it. Okay, now the last part is asking us how to reduce risk with foreign account receivables. Now, receivables can have challenges, but foreign account receivables have other challenges. Among us, like if you look at all the other challenges that you have with normal receivables, now the foreign account receivables have also foreign exchange risk. So that you can have a receivable of 5 million, but after some years you get 4.6 after some months. So one thing you can do is reduce investment in foreign currency. This is the thing that some people do. Like, no one is going to sell you and say you will pay me $50 after 3 months. Maybe dollars could be used that way because dollars tend to stabilize and all that, but even then you don't want to risk. So you realize that most times when you are dealing with the people, they would like you to pay them in their home currency. The other thing is that you can have if you are if you have if you're going to sell to someone who's not in Uganda, you should have a letter of credit. So letters of credit are usually given by a bank, and basically that would have a connotation that the bank says that this person is creditworthy, they are willing to pay. Basically, you are like guaranteeing that the person is going to pay the money. In fact, we can also look at credit insurance, whereby still you have insurance for the payment that you are going to receive that money. And basically, what you're doing is you're saying, basically what you're saying is that you're saying that the person be able to pay, and if they don't, I will be able to maybe guarantee, like if they don't pay, we shall pay. Some companies deal with like that with their clients. So this is how you can deal with them. And you can see that. So I don't know if you guys have any questions on this. And okay, it's okay. So I guess we shall stop here for today, and then I'll see you tomorrow.
Okay, thank
All
you.
right. Thank you.
Yeah.